All right, let's dive right in. Today, we're tackling a real puzzle that has the entire market scratching its head, what we're calling the AI paradox. We are living through a massive technological revolution, right? Companies are putting up these absolutely mind-blowing numbers, and yet their stocks are falling. So what is going on? We are going to break down this strange disconnect between record-breaking earnings and some really surprising price action.
Okay, so let's start with the company that's right at the center of all of this, Nvidia. I mean, by any traditional measure, their last earnings report wasn't just good, it was, frankly, a work of art. We're talking revenue hitting $68.1 billion, just completely blowing past what anyone expected. And the engine behind that? Their data center business, which grew by a staggering 73%. On paper, you just can't get any better. The numbers were flawless.
And yet, after posting those unbelievable results, the stock sold off. So this is the central question, right? The one everyone is asking. If a perfect report card isn't enough to make a stock go up anymore, what on earth is really happening under the hood of this market?
Well, here's the thing. The answer isn't hiding somewhere in Nvidia's balance sheet. To really, truly understand what's happening, we have to pull the camera way, way back. We have to zoom out from this one company and look at the entire economic landscape. The clues to this mystery, you see, they're not at the micro level. They're all in the macro environment.
And this is what that landscape looks like right now. We're seeing some pretty clear signs of what a lot of strategists are calling stagflation light. And just look at the data. It tells the story. GDP growth has slowed down a lot, dropping from over 4% to just 1.4%. But at the same time, inflation is just sticky. It's hanging around, especially in services, holding at 2.4%. And this combination, slower growth with inflation that won't go away, is basically the perfect recipe for investor anxiety.
Now, that messy economic data has a direct consequence. It has kicked off what looks like an all-out civil war inside the Federal Reserve. You've got the doves on one side who are looking at AI and saying it's this powerful anti-inflationary force, and they're pushing for rate cuts. But then you've got the hawks who are looking at the still strong labor market and just slamming on the brakes. This fight, this internal conflict, creates some deep uncertainty, and it's forcing the market to keep pushing back its bets on when that first rate cut will actually happen. So with all this uncertainty swirling around, what is the smart money doing? They're not panicking. They're not running for the exits. Instead, they're starting what's being called the Great Rotation. And this isn't some fearful move out of the market. No, it's a strategic, really intelligent shift of capital. They're moving money out of the stocks that are already priced for perfection and hunting for value in other areas that have more room to run. This slide illustrates that rotation perfectly. Think of it like the classic gold rush playbook. At the very beginning, everyone rushes out to buy picks and shovels, right? But the really smart money, eventually, they sell those picks and shovels to invest in the essential infrastructure, like the power plants that are needed to run all the mining equipment. In today's AI gold rush, the picks and shovels are the AI hardware, the chips. The power plants are the software platforms and, well, literally the power utilities that fuel this whole operation. And here's the proof, right here in the numbers. Look at this. On the very same day that AI hardware stocks fell 3.5%, software stocks jumped over 2%, partly because of a big short squeeze. And check out utilities, up 1.5% as investors finally realize the insane amount of electricity AI is going to need. See, this isn't a market crash. This is a very precise, very targeted reallocation of capital. And this smart rotation isn't just happening between different sectors inside the US. That capital is now crossing borders. It's going global. So with the US dollar weakening a bit, it's like opening the floodgates. A huge wave of liquidity is now flowing out of expensive US tech stocks and into these undervalued Asian markets. We're seeing a ton of capital pour into places like South Korea, Japan, and China. And why? Because these are the countries that are home to the critical supply chains for semiconductors and memory, the absolute guts of the AI revolution. It's a classic global hunt for value. Okay, so we've covered the rotation and the bigger macro picture. But the analysis we're digging into warns that the risks everyone is talking about, inflation, the Fed, they might not actually be the biggest threat out there. There's another danger, one that's kind of lurking just beneath the surface. And this is it. The real tail risk, that low probability but super high impact event, could be this hidden time bomb in the private credit market. The iceberg metaphor on this slide is just perfect. What we all see in the public markets, the tip of the iceberg. It looks pretty stable. But the real danger is what lies unseen, below the waterline, in the murky world of private lending. So what is the problem here exactly? Well, private credit operates as this massive, mostly unregulated shadow banking system. And get this, a recent analysis found that over 23% of it is exposed to software companies. Many of these companies were bought by private equity firms using just enormous amounts of debt. So if interest rates stay higher for longer, these companies, loaded up with debt, become incredibly vulnerable. The nightmare scenario here is a corporate debt crisis that starts to feel a little too much like the 2008 mortgage meltdown.
So this really leaves us at a crossroads with two very different paths forward. In scenario A, the bullish case, that great rotation we talked about works out perfectly. Capital flows smoothly into new leaders like software and utilities, and the whole rally continues. But then there's the bearish scenario B. This is where those hidden risks in private credit finally surface, triggering a really painful deleveraging, basically a forced selling of assets to pay down debt that could ripple across the entire market.
So with those two paths in mind, here's what the institutional playbook looks like right now. The strategy is pretty clear. Go long on the obvious beneficiaries of the whole AI build-out. That means utilities and key Asian markets. At the same time, you stay cautious on the broad S&P 500, and maybe you even consider some tactical shorts on the most over-the-top, overextended semiconductor stocks, the ones that are already priced way beyond perfection.
But of course, even the most well-thought-out strategy can get completely derailed by a black swan. That's the unpredictable, high-impact event that nobody sees coming. And the one the market seems to be almost ignoring right now is a major geopolitical oil shock, one that could look an awful lot like the crisis we saw back in the 1970s. 20%? Just let that number sink in. That is the share of the entire world's daily oil supply that has to pass through the Strait of Hormuz. If a potential blockade there, sparked by geopolitical tensions, were to happen, that supply would instantly vanish. The result would be a catastrophic stagflationary shock that would throw every single economic forecast and investment strategy right into the fire.
And that brings us to the final verdict from the strategist behind this report. It's a single quote that just perfectly captures the market's new mindset. In a market priced for perfection, good is not good enough. It is time to value cash flow over narrative. In other words, the era of just investing in exciting stories, that's ending. It's being replaced by a simple demand for cold, hard, provable cash flow.
And so that leaves us with one final question for you to think about. As you watch this great rotation unfold in real time, what are you focused on? Is it the popular, really exciting narrative of the AI revolution? Or is it the less glamorous, but maybe far more important, underlying cash flow of the businesses you're watching? The answer to that question might just determine how you navigate the very complex market that lies ahead.